Margaret owned her home for 34 years. She bought it in 1991 for $87,000. She raised 3 kids in that house. She painted every room herself. She replaced the roof in 2009 and put in a new kitchen in 2017. She retired in the spring of 2025 and decided to downsize. The market in her area had been strong for years. She sold the house in September for $612,000. She figured she knew exactly what she was dealing with. She had read about the home sale exclusion. She knew married couples could exclude up to $500,000 in gains. She thought she was fine. She was not fine. By the following March, she had received a CP 2000 notice from the IRS proposing over $28,000 in additional tax, not because she cheated, not because she hid anything, because there were 4 specific things the IRS checks on every home sale return that Margaret had never been warned about. And in her 34 years of home ownership, not one of them had ever mattered. Because when you own a home and you're working, the IRS barely glances at your address. The moment you sell that home in retirement, it becomes one of the most scrutinized transactions on your entire return. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Kevin Retires. Every week I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Today I am going to walk you through the specific things the IRS now watches on every home sale involving a retiree. These are not general concepts. Each one has a specific form, a specific calculation, and a specific penalty if you get it wrong. The IRS received your Form 1099-S from the title company before you ever filed. It already knows you sold. The question it is asking when it looks at your return is whether you calculated everything correctly. And in 2026, with the IRS deploying AI-driven matching systems that cross-reference third-party data faster than any manual auditor ever could, the margin for a miscalculation that goes unnoticed is essentially zero. The first thing the IRS examines is whether your adjusted basis is calculated correctly. Most retirees think their basis is what they paid for the house. It is not. Your basis is your original purchase price, plus every qualifying capital improvement you made over the years. A capital improvement is not the same as a repair or maintenance. Repainting a room is not a capital improvement. Replacing a broken furnace is not a capital improvement. Adding a room, putting on a new roof, replacing all the windows, installing central air, remodeling the kitchen, those are capital improvements. Each one increases your adjusted basis and reduces your taxable gain. Here is why this matters precisely. If you paid $87,000 for your home and sold it for $612,000, your gross gain appears to be $525,000. If you are filing jointly with your spouse and both of you qualify for the full Section 121 exclusion, you can exclude $500,000. That leaves $25,000 of taxable gain at long-term capital gains rates. But if you spent $60,000 in qualifying capital improvements over 34 years, your actual adjusted basis is $147,000. Your actual gain is $465,000. The entire amount is excluded. Your tax liability is zero. The IRS will not calculate this for you. The IRS sees the gross proceeds from the 1099-S. It compares them to what you report on Schedule D and Form 8949. If you report zero gain and the IRS calculates a large gain based on estimated basis, it will send a notice. The documentation burden is yours. That means receipts, contracts, permits, actual records going back to the original purchase. For a home owned 20 or 30 years, this is harder than it sounds. Many retirees have thrown away those records. Some never kept them. Before you sell any home you have owned for more than a decade, pull together every capital improvement you can document. Even partial documentation reduces your gain. No documentation means the IRS uses the purchase price as your full basis and proposes tax on every dollar above it. Let me put a real number on what proper basis documentation is worth. Margaret paid $87,000 for her home in 1991. She sold for $612,000 in 2025. Over 34 years, she spent approximately $74,000 on qualifying capital improvements. New roof in 2009, $14,000. Kitchen remodel in 2017, $41,000. Central air conditioning in 2003, $9,000. New windows in 2013, $10,000. With those improvements documented, her adjusted basis is $161,000. Her actual gain is $451,000. With the $500,000 joint exclusion, the entire gain is excluded and no tax is owed. Without those records, her basis appears to be $87,000. Her apparent gain is $525,000. The exclusion covers $500,000. she owes capital gains tax on $25,000. At the 15% long-term rate, that is $3,750 in tax she did not have to pay. On a home held 34 years, the difference between documented and undocumented improvements can easily be tens of thousands of dollars in unnecessary tax. The second thing the IRS examines is the ownership and use test under Section 121 of the Internal Revenue Code. The Section 121 exclusion, the $250,000 for single filers and $500,000 for married couples filing jointly, does not apply automatically to everyone who owns a home. You must have owned and used the property as your principal residence for at least 24 months out of the 5-year period ending on the date of sale. And you cannot have used the exclusion on another home sale in the 2 years before the current sale. For most retirees who have lived in one home for 20 or 30 years, this test seems obvious. Of course they lived there. But 3 specific situations create problems that the IRS flags every year. The first is the retiree who moved to an assisted living facility, a memory care unit, or a nursing home before selling. The IRS has a specific rule for this. If you become physically or mentally incapable of self-care, the use test is modified. You only need to have lived in the home for 12 months out of the prior 5 years, not 24 months, provided you lived in a licensed care facility for the remainder. The rule is in Publication 523. Most retirees and their families who sell the home after a parent moves to a care facility do not know this reduced use requirement exists and do not know it must be claimed specifically on the return. The second situation is the retiree who rented out part of their home before selling. Maybe they rented a basement apartment for 5 years to help with retirement income. That portion of the home was not used as your principal residence. It was a rental. The gain attributable to the rental portion of the property does not qualify for the Section 121 exclusion. The IRS requires you to calculate what percentage of the home was used for rental purposes, allocate the gain proportionally, and report the taxable portion on Schedule D and Form 8949. The rental depreciation you claimed over those years creates a separate depreciation recapture liability, taxed as ordinary income at a rate up to 25% on top of the capital gains calculation. The third situation is the retiree who sold a home that was also used as a home office for a business. If you claimed a home office deduction using the actual expense method, any depreciation you deducted against that home office reduces your basis and creates a recapture liability at sale. You cannot exclude that portion of the gain. The IRS cross-references your prior Schedule C or Form 1040 home office deductions against the gain you report when you sell. If you took home office depreciation for 10 years and then excluded the entire gain, the IRS will flag it. The third thing the IRS watches is the Form 1099-S itself. When you sell a home, the title company or settlement agent is required by law to file a Form 1099-S with the IRS reporting the gross proceeds of the sale. That form arrives at the IRS before you file. It shows your name, your address, the date of sale, and the gross proceeds. The IRS matches it to your return automatically. If you receive a Form 1099-S and your entire gain is excludable under Section 121, you still may need to report the sale. The IRS requires you to report the sale on Schedule D and Form 8949 if you received a Form 1099-S, even if no tax is owed. This is the rule that catches the most retirees. They know the gain is excluded. They figure there is nothing to report. They skip Schedule D entirely. The IRS receives the 1099-S showing $612,000 in proceeds and sees nothing on the return explaining it. That triggers an automatic CP 2000 notice proposing tax on the entire proceeds amount because the IRS, without an explanation on your return, has no way to know you qualify for the exclusion. There are 2 narrow exceptions to the reporting requirement. If the gain is fully excludable and no Form 1099-S was issued, you are not required to report. And if the gain is fully excludable but a Form 1099-S was issued, the IRS has indicated in Publication 523 that you may be able to avoid reporting in some circumstances. But the safest position, and the position most tax professionals take in 2026, is to report the sale, show the full gain, apply the exclusion on the return, and arrive at zero taxable gain with the documentation to back it up. Do not assume the IRS will figure out the exclusion applies. Show your work. If this is helping you understand what could be sitting in your home sale return right now, hit the like button and share this with any retiree you know who is thinking about selling. Subscribe and turn on the bell so you never miss a video like this one. The fourth thing the IRS examines is whether the gain you are reporting is being correctly affected by the net investment income tax. Most retirees know about capital gains taxes. Far fewer know about the 3.8% net investment income tax that kicks in above certain income thresholds and can apply to home sale gains that exceed the Section 121 exclusion. Here is how it works. The Section 121 exclusion reduces your taxable gain, but it does not reduce your modified adjusted gross income for all purposes. If any portion of your home sale gain is taxable after the exclusion, that taxable gain is included in your modified adjusted gross income for purposes of the net investment income tax. If your modified adjusted gross income for the year exceeds $200,000 as a single filer or $250,000 as a married couple filing jointly, the taxable portion of the gain is subject to an additional 3.8% tax calculated on Form 8960, which must be attached to your return. For most retirees selling a primary home with a gain under $500,000 and a joint filing status, the entire gain is excluded and neither the capital gains tax nor the net investment income tax applies. But for a retiree who is single, whose gain exceeds $250,000 or whose gain after the exclusion leaves a taxable remainder, the net investment income tax adds a tax on top of the capital gains rate that many people have never heard of and never modeled in their planning. Let me walk through what happened to Margaret specifically. Margaret and her husband sold for $612,000. Their adjusted basis, because they had not kept good records, appeared to be $87,000. Their apparent gain was $525,000. The $500,000 joint exclusion covered $500,000 of that. The remaining $25,000 was taxable. Their combined retirement income for the year was $84,000 from Social Security, pension, and IRA distributions. Adding the $25,000 taxable gain brought their modified adjusted gross income to $109,000. That is below the $250,000 threshold for the net investment income tax. The long-term capital gains rate at their income level is 15%. They owed $3,750 in capital gains tax, plus a penalty for failure to report the sale on Schedule D. That is the notice that arrived in March. The fix was documentation, with Margaret's kitchen receipts, her roofing contract, and her window installation invoice recovered from a filing cabinet. Her advisor corrected the basis. The amended return showed an adjusted basis of $161,000, a gain of $451,000, full exclusion, zero taxable gain, no capital gains tax, no net investment income tax. The amended return resolved the notice completely, but recovering and organizing those documents, responding to the IRS, and filing an amended Form 1040X took 3 months and cost her over $800 in accounting fees. None of it needed to happen. Here's your action checklist for the home you own right now, whether you are planning to sell soon or not. For your adjusted basis, start a home improvement file today. Every receipt, every permit, every contractor invoice goes in that file. If the improvement qualifies as a capital improvement under IRS Publication 523, keep the record indefinitely. Do not wait until you are under contract to sell. The records you throw away today are the ones you will need most in 10 years. For the ownership and use test, confirm that both spouses in a married couple meet the 24-month use requirement individually if you plan to claim the full $500,000 exclusion. If one spouse died and the surviving spouse is selling within 2 years of the death, a special rule under Section 121 may allow the full $500,000 exclusion even on a single return. This rule has a strict deadline. The sale must close within 2 years of the date of death. Miss that window by a day, and the exclusion drops to $250,000. For the 1099-S, when you reach the closing table, ask the title company whether a Form 1099-S is being filed. If it is, plan to report the sale on Schedule D and Form 8949, even if no tax is owed. Prepare your calculation in advance, show the full gain, apply the exclusion, show zero taxable gain, and attach the return with that documentation. Do not leave the IRS to guess. For the net investment income tax, run your projected income for the year of the sale before you close. Add your Social Security, your pension, your IRA distributions, and any portion of the home sale gain that will not be covered by the exclusion. If that total approaches $200,000 for single filers or $250,000 for joint filers, the net investment income tax may apply to the taxable gain. Calculate Form 8960 before you file and include it with your return. For any portion of the home that was rented or used as a business, contact a tax professional before you sell and before you close. The depreciation recapture calculation must be done correctly. It is separate from the Section 121 gain calculation. It cannot be excluded, and it must appear on Form 4797 and Schedule D. The IRS has the depreciation deductions from your prior returns. It will look for the recapture. Now let me tell you about Dennis. Dennis is 69 years old. He is a retired engineer, he is methodical, careful, and has filed his own taxes for 30 years without a single problem. He sold the home he owned for 22 years in the summer of 2025. His gain was $380,000. He and his wife qualified for the full $500,000 exclusion. He correctly identified that the entire gain was excluded. He did not report the sale on Schedule D because he had read somewhere that reporting was not required if the gain was excluded. He had rented the basement apartment of that home for 7 years, ending in 2018. He had claimed depreciation on that rental portion during those years. When he sold, approximately 18% of the home's value was attributable to the rental portion based on square footage. The depreciation he had claimed totaled $22,400. That amount was subject to recapture as ordinary income, regardless of the exclusion. The IRS had the prior Schedule E returns showing every year of depreciation. When Dennis filed nothing related to the home sale, the IRS matched the 1099-S proceeds to the return, found nothing, and sent a CP 2000 notice proposing tax on the entire $380,000 as unrecognized gain. Dennis resolved it by filing an amended return with the full gain calculation, the Section 121 exclusion, and the depreciation recapture amount shown on Form 4797. His actual tax liability was $5,600, which was the tax on the $22,400 in recaptured depreciation. He owed no capital gains tax on the home appreciation. But the notice, the amended return, and the 4 months of back and forth with the IRS were entirely avoidable if he had known in advance that the rental history created a recapture obligation that survived the exclusion. Here is the practical tip that saves most retirees from the home sale audit cycle. 12 months before you plan to sell, sit down and build what tax professionals call a basis schedule. List your original purchase price. Then go year by year and list every capital improvement you can document. Estimate any improvements for which you no longer have receipts, noting those separately as estimates only. Calculate your adjusted basis from that list. Then subtract your adjusted basis from your expected sale price and compare the result to the exclusion limit that applies to your filing status. That comparison tells you in advance whether any portion of your gain will be taxable. If it will, you have 12 months to plan for it, to gather documentation that reduces the taxable portion, and to model the impact on your Medicare premiums, your Social Security taxation, and your overall retirement income plan. If the gain is fully excluded, you still know before you sign the listing agreement that the documentation is in order. There is one dimension of the home sale that connects to every other retirement tax system that is worth naming directly. The year you sell your home may be the year your income spikes more than any other year in retirement. Even when the gain is fully excluded under Section 121, the sale may increase your gross income through the Social Security taxation formula, push you over the URMAA threshold for Medicare Part B premiums, and change your estimated tax obligations for that year. These systems do not talk to each other in real time, but they all read from the same tax return. A retiree who sells a home, receives $600,000 in proceeds, excludes the entire gain correctly, and then ignores the effect on the rest of the year's income, can end up with a Medicare surcharge 2 years later that wipes out the tax savings from the exclusion. Model the full picture before you close. The home you own right now may be the single largest financial asset you have. The IRS knows that. It has the Form 1099-S the title company filed. It has your prior returns showing any depreciation you claimed. It has the AI tools to match the proceeds to your return within weeks of filing. What it does not have is your documentation, your basis records, your improvement receipts, your use history. That documentation is the difference between a home sale that is completely tax-free and one that generates a 5-figure notice you were never expecting.